Hi, Chris. Thank you for joining us today. And I hope it's a great morning in Australia, I suppose. Um, okay, Chris is the founder of StockSpot. Founded in 2013, StockSpot is Australia's largest robo-advisor, if I'm not mistaken, investment advisor. And Chris is with us today to talk about the role of financial technology in responsible investing. And tell me about yourself, Chris. You know, I understand from a little I know that you started investing. I mean, you got your introduction to investing at a very young age, at the age of 9, right?
Yeah, that's right. And yeah, thanks for having me on. And sorry, I couldn't be there on the day. Unfortunately, I'm expecting a baby. So by the time people see this, I might have another baby.
Congratulations.
Yeah, you're right. I actually started investing when I was pretty young. I think I was 9 or 10 years old when my dad first introduced me to the share market. He wasn't, he wasn't in finance. He's actually a dentist, but he gave me the newspaper and allowed me to pick a share to invest in. And ever since then, I've been fascinated by markets. During school, I used to enter trading competitions. I was lucky enough to win a few times. And then I got my first job out of university at UBS, the big Swiss bank, where my role was to actually trade the bank's money, which was a pretty fantastic role for a graduate coming out of uni to be able to essentially speculate with the balance sheet of a big investment bank. So yeah, that's where I got my grounding. And then after working there for 6 years, I had the idea of starting a very different business. I was used to trading kind of professional money, but I thought there was a great opportunity to start a digital, direct-to-consumer wealth management business that really wasn't about sort of trading short-term markets, which was what I was used to, but really long-term investing. So it was quite a change for me, but it's been a great learning experience starting a business and growing it from scratch.
So, okay, you mentioned direct-to-consumer sort of business, right? I mean, in the 6 years that you were with UBS, there must have been some thought. You've been monitoring how financial technology has liberalized the financial sector, and I suppose that's how you thought about democratizing finance, if I'm not mistaken. So
yeah, I mean that's right. I mean, probably in the later years. I mean, I started there just before the financial crisis, and it was really after the financial crisis, I think, that fintech or financial technology, really started to emerge.
Mm-hmm.
I think initially out of North America, I noticed a few businesses out there, doing some interesting stuff in terms of offering, products and services direct to consumers, and essentially picking a vertical that a bank used to offer in the past, but digitizing it, making a really slick customer experience, removing a lot of frictions, and often removing costs. And I think a lot of the early fintechs kind of had that in common, whether they're in, money transfer or or investing like we are. It was all about creating a slick customer experience, reducing costs and frictions. So I had noticed that. I think the equivalent to our business in the US called Wealthfront or Betterment, they had launched, just after the financial crisis, really. And I had seen some of their early growth in 2011 and 12. And I think after that, that's part of what inspired me to start the business. It gave me a little bit more confidence to see that other businesses around the world had a similar idea to what I thought would work. And yeah, I mean, I was really trying to solve a real problem that I think a lot of my friends had, which was that, they would come to me knowing that I work in finance and say, hey, Chris, like, how should I invest my money? And a lot of these people weren't in finance, so they didn't have the confidence to go and do it themselves. They wouldn't have set up an online brokerage account because they thought that was too risky.
Mm-hmm.
But at the same time, they didn't really have the amount of money you needed to go and see a professional financial advisor. So they were kind of stuck in this limbo land where they couldn't afford to pay for advice. They were scared to do it themselves. And so most of them would just sit on the cash in the bank and earn a pretty poor interest rate, rather than enjoy the benefit of compound returns just because they were too frightened. So, for me, that was the opportunity, was actually helping a lot of my friends and family work out a really smart way to invest that didn't require a big starting balance and didn't require any knowledge.
The whole idea is basically to demystify investments then, you'd say that, right?
Yeah, that's right. I mean, I think there's probably a few aims, like democratizing investing, is important. So giving access to more people, that was an opportunity. So, when we started, we allowed people with as little as It's 2,000 Australian dollars, which is, more like 1,200 US dollars to start investing. Where in the past, to see a financial advisor in Australia, you need, probably upwards of $200,000, or for some financial advisors, over $1 million. But also, I think equally to that, it wasn't just about democratizing investing, because I think there's a lot of other apps out there that do that. But we're trying to democratize investing in a sensible way for the long-term accumulation of wealth. We're quite different to a lot of the trading apps out there that also democratize investing, but they essentially democratize, speculating or gambling, which I think is what a lot of people think investing is. Certainly when I was a kid, I thought that picking stocks or trying to know when to get in and out was what investing's about. When really, something I learned in my career is that only a very small fraction of people can do that successfully. Because markets are so competitive, there's only 1% of professional traders that can kind of get in and out successfully on a consistent basis. Whereas what people really should be doing is not trying to, get in and out quickly or work out what stocks to buy, but just own a really smart, balanced portfolio of, index funds, or owning across all of the shares in the market. So you're guaranteed a good long-term return without taking too much risk. So for me, it was part democratization, but part education. I think a lot of people in Australia didn't realize there was a sensible way of investing that didn't require, picking shares or timing the market. And I really wanted to, educate and inspire people to learn about that.
So, accumulation of wealth, it's that's why it's called accumulation. It's in the long term, right? So that's the whole idea of robo-advisory. You use index funds, ETFs. But why did you think it was important to enable people with different levels of capital to actually invest? Well, and why is it important to even provide them that ability?
Well, yeah, first of all, you're right. It is very long term. I think people don't realize that if you're investing over a few weeks, you've got a 50-50 chance of making money and a 50% chance of losing money. So it really is just gambling over the short run. And really the power is in kind of leaving your money in investment markets for a long time, that you really enjoy the power of, compound returns. So yeah, a lot of our product design has been about helping nudge our clients to make sure that they're doing things for the long run and that they're not trying to get in and out for the short term. But why is it important? We know from history that investing is one of the best ways to grow your money over the long run, because, money essentially makes more money. But in the past, it's really only been wealthy people that have had access to investing in public markets in a smart way, because they can afford to get advice from, a professional advisor. And as a result, my impression is that it's only really wealthy, informed people that have been able to enjoy the benefits of compounding, probably for the last 100 years. Whereas, people with very small balances, are either too scared to get involved, or they get involved in the wrong way and take stock tips that don't work out. So we're basically seeing a big disparity in our society of, the people that are already rich getting richer because they can afford to get good advice and invest their money in a smart way. And then the people that don't have a lot of savings, they don't get any advice, and they basically don't invest. And as a result, they fall further and further behind. They won't be able to, enjoy the benefits of being able to purchase things they want in the future, or potentially retire in the way that they wanted. And so, yeah, I think robo-advice or services like ours do help to bridge that gap and give access to people that don't have a lot of money, the same level of sophistication in their investing. And to me, that's really exciting. The fact that someone with, $1,000 can invest in the same way that someone with $1 million can invest, and they can earn a similar return, that's really awesome, because it means a lot of people who weren't investing in the past can suddenly start to enjoy the benefits.
Okay. So when you talk about today, the robo-advisory platforms, they've even, if it has evolved so much that you can even do micro investing, invest your spare change, right? It doesn't even have to be 1,000 Aussie dollars, for example. I guess that falls into that whole concept of the SDGs, the Sustainable Development Goals, and the idea of eradicating poverty in the long term. So how does where does fintech and responsible investing come? How do they come together? And could you talk about how do you make investing more responsible?
Yeah, sure. So, I mean, you're right. There are, as well as services like ours, we've got a slightly higher bar to start investing because we're actually providing personal advice to each client. Whereas a lot of micro investing services, it's more of a do-it-yourself self-service platform. But they're also fantastic because, then even with a couple of dollars, you can actually start investing and you can round up transactions and invest. They even take things a step further than us in opening up investing to even more and more people, that don't even fit inside our bucket. So you're right. I think that's another option. In terms of making, meeting some of those sustainability goals, I mean, I think fintech broadly does it in a few ways, I would say. So, first of all, it's that it's cost effective. So, in the past, there probably were options for some of these smaller balance people to start investing, but they were really expensive. And that made them not very effective in the long run. So I think technology has helped to bring down the cost to the point that things actually make sense for people to do. It makes sense for people to invest with not a lot of money. Fractional shares is a good example of this, where you don't need to own whole units in shares now. You can own part units. The second one is that it's simple to do, and it's the feedback we get most often from our customers when we ask, what do you like about our service? The word that comes up all the time is simple and easy. It basically takes the hassle of having to do the research and the work and the paperwork away from people. And these are all frictions that stopped people from investing. So I think, the technology can make things a lot easier for people as well. And we know that the easier you make something, the more likely someone is to do it. And then I think the third one is probably transparency. In the past, when you invested, it was very hard for you to know what you invested in. And this is particularly relevant for ESG or sustainable investing, is that, there were sustainable funds out there, but it was very hard to know actually what you owned. And so it was hard to determine whether the sustainable fund that you were investing in aligned with your own personal ethics and values. Now one of the big benefits we're seeing is that there are a whole swathe of new low-cost and very transparent ethical options where you know exactly what are inside them. And so you can make sure that you've chosen one that aligns with your particular views on the world. And it's something, so we actually launched quite recently. We've had for 6 years now our traditional portfolios, but we've launched ethical versions of each of those portfolios, which invest in specific types of exchange traded funds that have a focus on removing companies that are deemed to be doing things that are unsustainable and adding more investments into companies that are seen to be sustainable. And the great thing about these ETFs is that we can communicate to our clients exactly what companies that they do have in their portfolio and that they don't have in their portfolio. And we actually surveyed our clients to work out what were the types of investments they were and weren't comfortable having in their portfolios. And so that actually helped to shape which funds we chose. For instance, we found out from our clients that the one issue that they were most passionate about was that they didn't want to be invested in any companies with investments in fossil fuels. Right. And so when it came to coming up with our priority list of what was important, we made sure that all of the funds that we invest in do not have fossil fuel producing businesses in them. I think costs, transparency and simplicity are probably three areas that fintech really help to push forward that sustainability agenda.
Sorry, just give me a minute. Okay, when you mean that the fact that the funds that you are investing in for StockSpot, for example, does not have fossil fuel ETFs or index funds, but does that then limit your investment horizon?
Good question. It's probably one of the more common questions we get from clients is, look, if you start to remove companies from a portfolio, is it still a good balanced portfolio? Could it still give the same returns over the long run? And this is something, fortunately, we can do a lot of testing on these days. We can have a look and back test the portfolios and compare them to a traditional index portfolio. Actually what's quite interesting is over the last 5 years, these ethical or sustainable portfolios have actually done a little bit better than a traditional portfolio. And actually taken about a similar level of risk. And the reason is more cyclical, which is that oil stocks or fossil fuel stocks over the last few years have been some of the poorest performing shares, because the oil price has plummeted and that sector of the market hasn't performed well. You've actually benefited by not having those companies in your portfolio. And typically that money that's come out of those energy shares has gone into sectors like healthcare and technology. And those are two sectors that have performed very well. Mm-hmm. So what we actually see is over the last 5 years, ethical or sustainable investing has done really, really well. And that's probably why we're seeing more demand for it now, is people are, see the recent returns and are feeling like it's a hot place to invest. However, if you take a step back and look over much longer periods of time, 10, 20 or 30 years, what you actually see is that sustainable portfolios perform in a pretty similar way to traditional portfolios with a pretty similar level of risk. The only difference really is that they have different sector tilts, as I mentioned before. So you're going to have some periods of doing slightly better or worse. And the other thing is, historically, ethical funds have much higher fees. And this is one of the problems I had with many of the traditional ethical funds in Australia, is that, they did a good job in removing companies that weren't seen to be sustainable. However, they often charged fees of something like 2% per year. Mm-hmm. And we know that fees have such a negative impact on your performance over the long run that any portfolio that's charging 2% a year in fees is really not going to give you a great long-term performance. Mm-hmm. So I always felt a bit conflicted. I almost felt like these ethical funds were unethical in having high fees. They themselves were unethical to have such high fees, knowing the harm that fees cause. But the great news is these days, the fees of ethical funds have really come down a long way. So they're more affordable and they're more likely to give you a similar result.
Yes, ESG investing has been growing quite tremendously over the past years and gaining traction. And would you attribute that to the changes in demography, for example, and people wanting to do more for beyond their capabilities or beyond their financial capabilities?
Yeah, I think that would definitely be one of the reasons. So since we've launched our sustainable portfolios, we've had a decent number of clients already switch over. I think it's like 5 or 10% of our overall clients. And more than that when it comes to new clients who are joining, it's more like 20% of them are selecting these types of portfolios. What we typically see is that they're more attractive for people in their late teens, 20s and 30s. So definitely the younger generation feel more passionate about having an impact with their investments and not investing in companies they don't feel aligned to. We don't see as much interest with people in their 50s or 60s. So definitely there's a demographic shift. I think, in Australia at least, there's been a few events over the last few years that have really, make this front and center for people. Mm-hmm. I'm not sure if you guys would have seen, but at the start of this year, there were huge bushfires in Australia. Mm-hmm. And they were the biggest fires that we've seen in many generations. And the feedback we got from a lot of clients after that was that they were, a bit more focused on environmental issues, because they could actually see the impact that they were having, on our country. And I think, the COVID issue as well has made, health an issue that people are more focused on. So demography, yes, partly, just people looking out there and seeing issues that they, feel like they want to have an impact on. And then I think past performance is also something to do with it. So, in Australia, when, we see the ratings for ethical funds and how well they've performed relative to other funds, a lot of them are flowing to the top of the lists at the moment because they don't have oil stocks and they have more tech shares. And so whenever people see these rating lists, they're suddenly now being attracted to these funds because of performance. So I would say a combination of those three factors.
Okay. Okay, you talked about what is driving this change, and mainly it's because people can actually see what's happening to the world around them, right? And what will it take to sustain this change? Like, will responsible investing be the future? Will all investing be responsible?
Yeah, I'm not sure. It's in different countries, responsible investing has accelerated at different speeds. I think it's moved the fastest in Europe. And something I read recently said, close to 1 out of every $2 invested now goes into an ethical fund rather than a traditional fund.
That's
so definitely
impressive.
in Europe, it's something people are very passionate about. I think Australia and probably the US, North America is a little bit behind, and even I would say Asia might be even further behind us. I think, I also, although ethical investing does make people feel very positive about, their impact on the world, there is a sort of secondary argument, and it's one that Bill Gates makes, which is that you can have a lot more impact on the world by actually, investing directly in initiatives that are having a positive impact, rather than just investing in a portfolio that removes companies seen to be unethical. And the reason is that, when you're investing on the share market or through ETFs, it's a secondary market. And so the impact is very small on the underlying business because they've already got the capital. They don't need your money to continue their fossil fuel business. So by removing them from a portfolio, that arguably it may not have that much impact on the world. And some really think that, there is actually sort of no benefit because there'll always be another investor happy to buy those oil stocks at a cheap price if they're going to get a better return from them. So it may take kind of more government initiatives, I think, to really sort of further this agenda, because I think apart from the feel good factor, which our clients, definitely resonate with, there isn't a lot more impetus to kind of have more of these ethical funds or encourage companies to invest in an ethical way. I mean, in Australia, we're seeing from a corporate governance perspective, there's a lot more focus on this. And some of the big pension funds or superannuation funds in Australia have made it quite clear to some of the big corporates in Australia that this is something that they need to focus on. Otherwise they'll lose votes at their AGMs and they may lose investors. So I think some of the big investors are having a more direct impact on their businesses, where they can actually have a conversation with the businesses and say it's something that's important for their shareholders. I think we are seeing it in a few different ways. Whether, how fast this sort of happens, is another question, and what actual impact it has is also a question that, I think is still unanswered.
Okay. When you talked about super earlier, right? So these are institutional investors, their horizons are, you're talking about 30, 40, some even 100 years. In Japan, it's over 100 years. So, but most people don't have that kind of horizon. We are talking about 3 to 5 years. That's the long term. And like you said earlier, if you were to actually go for negative screening, that means you're losing out from your portfolio. And that is a very big concern for a lot of Asian investors. If I was to invest responsibly, it would also mean that, I'm actually taking a cut. I'm doing it more for passion rather than for investment. What would your advice be to people like this? Why it's it? Yeah.
Well, I think it's a common concern. And I mean, it makes a lot of sense because if you think, looking backwards, like what have been the most profitable companies in the world, I mean, they often fit into these categories that aren't necessarily seen to be ethical. Oil companies have historically been very profitable. Tobacco companies have been very profitable. Gambling companies have been very profitable. So it's a lot of these vices and a lot of these, industries that are seen to have a negative impact on society that are very profitable. And I think, that's probably where this concern comes from. People probably think if I don't invest in these companies that are, that are very profitable, I'm not going to, enjoy the same profits. I mean, the evidence doesn't really support that. From a portfolio perspective, what happens is you just take a bit of money out of some sectors of an economy, and you basically redeploy them into other sectors of the economy. Where those sectors do perform well, you may underperform, but also you're putting more emphasis on sectors that may be doing even better. Healthcare and technology are great examples at the moment. People that are ethically investing tend to have even more money invested in healthcare and technology. And these are industries that are really booming and growing very fast. So people, there are some people that are very passionate about ethical investing and they take a more extreme view. They think that, fossil fuel businesses will go out of business over the next 20 years. So actually you don't want to be anywhere near them because you'll probably lose all your money. If the last few years are anything to go by, I mean, things seem to be moving in that direction. So there is an extreme view that actually, it's the opposite of what people may perceive. You're not actually missing out on profits. You're actually avoiding potential landmines in your portfolio. You're avoiding, whole industries that may disappear, or have to change. And you're actually investing in the types of businesses that will be the beneficiaries when that happens. So it will probably be technology businesses that, benefit from, an energy revolution, for instance. So yeah, I mean, I sympathize with the concerns, but it's not really based on any sort of facts. And if anything, the trends would support that you actually want to have a little bit less invested in some of these industries, because the momentum behind reducing them in society is getting stronger rather than weaker.
So I would attribute that to, a herd mentality, that if my cousin is doing it or my uncle is doing it, they know better than me. They spend longer time on this planet, so they would. I would attribute that knowledge to that, honestly. But okay, I think we're at the end of our conversation.
You're more humble than a lot of young Australians who are trading at the moment. They think that they know everything. So
right. Okay. I would. Okay. Just to finish things off, to round things off, going forward, how does responsible investing, in your view, make the world a better place? Like, how can we drive this forward?
Well, first of all, I mean, there's a difference between responsible investing, which is what we offer clients, and impact investing. I think impact investing, where you're actually specifically investing in initiatives or causes that directly have a positive impact. I mean, I think that clearly does have a positive impact on society. And where you mentioned before, people that have concerns that they may not earn a return, I think those concerns are maybe more founded sometimes in impact investing, because that's where, non-commercial kind of considerations come into play. And you may decide to make impact investments that may not, be as commercially viable or successful. So, I think they are areas that, can probably have a real impact on the world. But they may not have the commercial sort of upside, that makes it attractive for a lot of people to do it. So that's probably why it's a lot of philanthropy, and a lot of money that, isn't sort of, retail money that flows into that impact investing, because, it's for people that have, feel like they have a higher purpose. On the other hand, there's obviously the responsible investing that, has less potential, immediate impact, but it actually makes people more conscious and aware of these issues. And I think that also has a role, because the more people, like you say, that are talking about these issues with their friends and family and are conscious of them, the more that, the public mind will change, whether it's from a political perspective or what people support in society. So I don't think, even though environmentally and socially responsible investing may not have the immediate impact, I think there is a longer term impact just by, changing how people think about things. That may be slower, but eventually, it will catch on. So I think, yeah, I mean, my answer is it's probably a combination of things that have an immediate impact, but may not be profitable, as well as things that may not have an immediate impact, but lead to, a lot of talkability and a lot of conversations that will drive things forward in the future.
All right. Thank you. Thanks a lot, Chris. I think I'm done with mine. I think we can end this session right now, right?
Perfect. Thank you.
I think we have.
All right. Good luck with the rest of the conference, everyone.
Yeah. Thank you. Bye.
All right. See ya.